Volatility's returned to the markets. Now the question is why? And there are some theories about different trades that are being unwound within the market, but there's also questions about slowing growth in the economy. Let's break it down to figure out how you should react. We'll start back in the beginning of 2022. That's when the Fed announced it was going to start hiking rates to combat inflation. The market assumed that these higher rates would eventually cause the economy to fall into recession. For 9 months, the market sank. But then in the fall of 22, we still hadn't seen a recession. Consumers were still spending, and the market responded by shooting higher, believing maybe the initial fears of a recession were overblown. We also got to fall in love with a new story that could drive that resilient growth even faster. It's called artificial intelligence. Yes, you've heard about it. So hand in hand they went. Consumers continued to spend. That made today's economy look bright. And AI continued to be built out. That made tomorrow's economy look even brighter. However, over the past few months, we're starting to see some cracks in those stories. Consumers seem to be weakening, and investors seem to be getting anxious about when AI will ultimately deliver on its promise to revolutionize productivity. Let's start with the economy. The government's latest jobs report confirmed what we are already seeing in the weekly jobless claims. The labor market is softening. More people are filing for claims and staying on unemployment longer. The economy added fewer than expected jobs last month, and the unemployment rate ticked up more than forecast to 4.3%. That still represents relatively low unemployment, but it's the rate of change here that's meaningful. Remember, early last year, the unemployment rate was nearly a full percentage point lower. Meantime, many of the companies' earnings reports I've read point to a consumer that's becoming more discerning in how they spend. I'm hearing that from travel companies and luxury brands to grocery chains and other companies that sell necessities. On the AI front, the build-out continues to accelerate. Mega-cap tech companies continue spending at a rapid clip, believing the rewards are going to be enormous. But for the moment at least, and yes, it's just a moment, the market seems to be getting a bit nervous as to when we'll see meaningful revenue and profits from those endeavors. This is the problem when all the good news is baked into the price. Even slight changes in perception can cause turmoil in the markets. That's true of the AI tech companies and of the market in general. This is why we talk a lot about fundamentals. This is why we talk about the real pricing of investments, how much you're paying for every dollar of earnings. They may not matter much in the short term, but they weigh heavily over the long term. So what should you do with this recent sell-off? First, understand where you are in your investing journey. This matters so much. Understand how far you are from your goals. If you're 35, you may be at least 20 years away from retirement. When it comes to your 401k or IRA, these sell-offs are your friend. You have lots more money you're going to throw into these accounts in the future, so lower prices are a benefit to you. But if you're in your late 50s, you've built up sizable savings and are looking to retire in 2 or 3 years, your future investment is quite limited. You're about to reverse course in a major way. Soon, you'll be done funding your account and will instead move into the distribution phase. You'll be pulling money out of your account. Even if your investments remain flat, you're going to see the value drop as you take money out. A sell-off only compounds that problem. Remember, a 10% drop requires just an 11% gain to get back to even. But a 20% sell-off requires a 25% gain to combat the loss. And how about this? A 50% sell-off requires a full doubling, 100% gain to offset the drop. This is why it's critical to better understand the downside risks of your investments. They matter far more as your wealth grows and your time frame to needing the money shrinks.